So as Paul said, I'm have got 30 years, which was when he asked me how long I've been in the industry. It was a bit scary to say, oh, okay. But anyway, there you go. And my role tonight is simply to take you through some of the aspects that impact your businesses, individuals, and I will comment a little bit about some of the housing things that the Treasurer announced last night. So first of all, small businesses, and my opening point will be there wasn't much in it. In fact, when I first, after the budget speech and we sat down to analyse the budget with my team, I thought, how on earth am I going to talk for 15 minutes? But anyway, we've got a few things that... So the key one though is the $20,000 write-off. Most people who are running businesses now would be aware that small businesses at the moment can get a deduction for plant and equipment up to $20,000 outright. So it's a really nice incentive to help people upgrade their equipment if they need to. And that was due to finish in a month or so, and it's been extended for 1 year. So that's it's quite handy. It also extends to technical term, pooling the depreciation. So if you've got a depreciation pool of assets, the balance of that can be up to $20,000 as well. So as that balance reduces, that's also a nice thing to have, because you get a higher rate of depreciation, and it's just a bit more straightforward technically for working out what your depreciation is for the year. So remember that if you're due for some new plant and equipment, you've got another year. I know that there's been a bit of chatter about trying to get things done by 30 June and getting orders in and those sorts of things. So breathe easy, unless you really need the tax deduction in the June 17 year. You've now got 18 as well to get that done. The Skilling Australians Fund, that has some impact for small businesses, and typically for the tax legislation, that's a definition of less than $10 million. Some things are less than 2, some things are less than 10, some things are less than 20, but this is 10. So if you are employing foreign workers on these particular visas only, then there's going to be a levy. A couple of them are once-off levies. One of them is a levy each year. So really important to know your employees' visa status if you are using foreign workers, and in particular if you're sponsoring people over here under either of those schemes, then that fee is a $3,000 fee for small businesses. If you're involved in a business that's got a turnover of greater than 10 million, then those numbers are actually a bit higher. It's $1,800 for the temporary skill shortage visa and $5,000 one-off fee for those other two. So not insignificant. The government's intention is that these are going to be put towards a fund to provide training and upskilling for Australians. So again, it's about, you know, what are we doing for our young people and our own, if you like, our own people. So, and there is currently a training benchmark obligations under the visa schemes. That's going to be repealed and replaced with these things. So other measures that do impact small business. Most people who have anything to do with the construction industry will be aware of the reportable payment system, where if you're employing or using subcontractors in your construction industry business, then you need to report payments made to them. That's now being extended to the cleaning and courier industries. So if you have a cleaning business or a courier business and you use subcontractors, you'll be reporting payments to those people to the tax office, providing those people with a payment summary, a bit like what you do for your employees. And just an aside, this is not really a tax measure, but it is an interesting thing from the point of view of startup companies and innovation, that there is a thing called crowdsourced equity funding. So where people go out to the internet and ask people to invest in their company. That's been set up for a while now for public companies, but it's going to be extended now to proprietary limited companies. So private companies that most of us would operate our businesses through, will now get access to that crowdfunding way of raising equity. The rules are slightly different and they're a little more relaxed than the usual rules of raising equity. It's limited to a maximum of $5 million in funding, and it's only if your assets are less than 25 million. So that's, it covers a broad range of businesses, and an individual person can invest up to $10,000 per year via this mechanism. So something to think about if you've got innovation happening in your business and needing some funding. So moving on to individuals. Just a few things. First of all, the Medicare levy. This is the tax increase that got the headlines, I suppose, this morning. It was the only thing that people could point to as a tax increase, if you like. But Medicare levy will be rising to 2.5% from July 2019. Currently 2%. But of course, some people are paying the budget repair levy, which is coming off as at the 30th of June 2017. So there was some chatter about whether or not the government would change their mind and keep the budget repair levy in, but it seems as though they are sticking to their commitment for ending it. So that's good news. So this 2.5%, or the 0.5% increase, is meant to be going directly to fund the NDIS. So they've identified a pretty big funding gap for that, and it's now the responsibility of the Australian taxpayer to make sure that our mates, as the Treasurer called them, with disability are looked after. So that obviously, any increases in Medicare levy usually end up impacting the rate for FBT purposes as well. So watch out for that too if you've got FBT to worry about. Help repayments, which I still struggle with. It was HEX when I went to uni, but anyway, it's called HELP now. So what this basically means is that people who graduate from uni on a modest sort of graduate salary are pretty much going to start paying back their help debt straight away. So the threshold's been reduced significantly, but the rate of payment's also been reduced. So I did the sums with my calculator, because that's what accountants do, and that works out to about $8 a week, or as Dom quite rightly said, a couple of coffees. So hopefully it won't necessarily be felt as much as it might have been at the 4% rate, but it is still bringing forward the beginnings of repaying the debt, and the maximum thresholds there are there too. So 10% of your salary is quite a significant amount. There's a scale that goes along with that, which is available on the internet. So just a few words about housing. This is I found this really interesting. Like, there's obviously been lots of debate about this, and it's been in the media a lot recently. And so the interesting things that the government have done are quite varied, really. There's quite a lot of they're coming at it from a number of different angles. The superannuation changes, there are some things, but I'll leave that to Dom to talk about, and obviously we can have a chat about that later if you've got questions. Investing in affordable housing, so they're trying to create an incentive for people to invest in affordable housing and increasing the CGT discount to 60%. So there's a few riders around that. You're going to have to be investing with someone who is an accredited provider of affordable housing. The investments will have to be, your investment will have to remain in there for 3 years. And most importantly, the rent will need to be a below market rent, at below market value. So it'll be interesting to see how that pans out and what actually happens in that space in terms of the provision of affordable housing. I'm a board member of Colony 47, so it's at the front of my mind a lot, how housing is provided for those who can't necessarily afford it. So it'll be interesting to see what happens in that space as this goes on. So the other things that they've done, foreign and temporary residents no longer eligible for the main residence exemption. So that'll be an interesting one. I expect we'll see as we come towards the end of 29, there'll be a lot of the people who are affected by this will be liquidating their properties to make sure they lock in their tax-free gain. So that provision commences pretty much straight away. It's July 2017, and if not from budget night, I can't remember exactly. So it'll be something to watch. And anyone selling their property, you may be aware that now that there is a declaration to be made if property's being sold and it was worth over $2 million. So there's not too many of us in Hobart that have properties worth $2 million, but there have been a few. You have to provide a declaration that you're not a foreign resident, or else the purchaser needs to retain, at the moment it's 10%, and remit that to the tax office. So it's a kind of a prepayment of the CGT that might be applicable to that vendor's property. So that's been raised to 12.5%, but the significant kicker for us here in Hobart is that the threshold's lowered to $750,000. So we will actually see a lot more, I think, of lawyers particularly sticking their hand up and saying, well, right, make sure we get this form filled in and get the declaration from the vendor that they're not a foreign resident. Rental properties. How many police officers have rental properties according to the Treasurer? Some sort of number, I can't remember exactly what he said. But anyway, they've taken away a few deductions that have been there for a very long time, one of them being travel expenses. So if you are travelling to inspect your property, going around there every couple of weeks to collect the rents, going around there to mow the lawns, make maintenance, and have been claiming the expenses associated with that travel, it's all gone. So this year's the last year that you'll be able to claim those deductions. And more significantly, I think, the depreciation deductions. So when you buy a property that already has fans, heaters, maybe a heat pump, stove, those sorts of things, the dishwasher, you can claim depreciation on those things even if, so you just make an allocation of the cost. And quantity surveyors particularly this is a significant part of their business for bigger residential properties where they assess what the depreciation is actually worth. As of 1st of July 2017, you won't be able to do that anymore. So any costs, so like any equipment that's already in the property, so the dishwasher that's sitting there, the stove that's sitting there, we won't be able to claim depreciation on those. The cost of those is just going to form part of the cost base. It won't matter if there's an allocation in the contract, that won't get around it, from what I can tell. There's very little detail out there at the moment, but it's reasonably clear that the purchase price of your property is just going to be the purchase price. It'll be a cost base for capital gains tax purposes, and the only thing you'll be able to claim depreciation on going forward will be anything that you buy that you put in. So that's got a number of questions around it, which we're yet to kind of, as I say, the budget papers give you a paragraph that's about that long. This thing's going to need a significant number of pages of legislation to get it right. So I'll be watching with interest to see how they go. And one final point on GST, and this is I'm still confused about this one. If you buy a new residential property or you buy into a development, you as the purchaser is going to be required to remit the GST to the ATO. So this is a significant shift, and it's an interesting one, and I'll tell you why I think it's interesting in a minute. But what it means is that the solicitor that's handling the conveyancing for the purchaser is going to get the funding from wherever the funding's coming from and then disperse the funding as they normally would do. So some goes to stamp duty, some goes to the to rates and all the rest of it, and then the rest goes to the vendor. But the rest is going to go to the vendor, less GST. New residential properties have GST on them. Oftentimes the purchaser isn't even aware, because it's really not relevant to me. If I'm buying a new house, I'm not going to claim GST, so I don't care. The price I pay is the price that I pay, but it will include GST, and for the vendor, then they need to remit that. What this means, I mean, it has a number of things. First of all, it's a bit more complicated, and the responsibility is on you as the purchaser to make sure that happens. Secondly, it has some significant cash flow impacts, I think, for the vendor. If you've got a vendor who is a quarterly remitter for their BAS, then the cash that they would have received as a result of the sale would include the GST, which they wouldn't need to remit until it was time to pay their BAS. But now, as soon as the transaction occurs, they're not going to have that cash because the solicitor is going to hold it back and send it off to the tax office. So I think there's some impacts there. What's interesting about that is that those of us in business know that the tax office are becoming more and more enamoured of the idea that we need to be remitting our tax in real time. So they've already started that process a bit with things like PAYG withholding for wages and superannuation guarantee payments, where you have to pretty much remit, certainly report. The next step will be remitting. And this is another thing, I think, in that direction, where at the time of the transaction, the tax is going to be paid. Now, this particular one's, I reckon it's complicated because where does the reporting lie and all of those sorts of things, but that's interesting to me because that's what I'm like. But it'll be something to watch out for, and certainly the lawyers around town will need to get their heads around that pretty quickly because it's July 18, which is probably only just long enough for the tax office to develop the form and get that right. But we'll see. So that's it from me in terms of those things. I'll hand over to Dom and he'll take you through some of the other things. Thanks, everyone.
Well, thank you. Firstly, thank you for WLF for inviting me to speak to you this afternoon. It's my pleasure to talk to you all. I might just introduce Luke Roberts and Cameron Pereira, who are our other advisors as well, for those of you who haven't met them before. I'm quite glad that I'm not talking to you, or wasn't talking to you this time last year, because the changes were huge, and we're all quite worried only a day after the announcements as to exactly what it all meant and how long we had to implement the changes. Fortunately, over the course of the last 12 months, in some respects, the changes or the announcements have been simplified, and we've had time to actually to take it all in. Last night was pretty placid by comparison, really. There wasn't a lot. I wasn't expecting a lot, but there really wasn't a lot of further fiddling, and only a few extra bits and pieces to take on board. And if a 0.5% increase in Medicare is the extent of tax increases, then that's maybe not so bad all in all, although the banks probably feel a bit differently at the moment. So what am I talking to you about this afternoon? I might change over, Mark, so you can see. So what did actually happen last night, and how does that impact wealth accumulators and retirees? There aren't that many points, to be honest, in that regard from last night. Not a lot of dovetailing back to the announcements last year and for the changes that will take effect on the 1st of July. But I will spend more time on that basis talking more about what it is that we need to do to be ready for 1 July. Fortunately, we don't have to be totally ready by 30 June and have everything in order. There are a number of things that we will need to bear in mind as we work our way into the year. So the key announcements, there is a little bit of overlap with the areas that Marg talked about before, but firstly there was an announcement with regard to first home buyers that will hopefully make housing a little bit more accessible and more affordable for people. There was also an announcement with regard to the Medicare, as Marg has said, which has placed a 0.5% impost on all Australians, not just high income earning Australians. The opportunity for retirees who are over 65 to top up their superannuation when they downsize their home to something less expensive, maybe smaller, and some incentives for investment in affordable housing. So the Young Savers announcement is sort of a reincarnated version of prior iterations, but more or less what this is the ability for people to contribute to super and to benefit from putting gross income into superannuation at a 15% tax rate, to then pull the money out when they are buying their home, when they're putting the deposit down. There is some tax to be paid on the way out, but I guess the theory is that the 30% rebate should mean that that withdrawal is either tax-free or only subject to a relatively modest amount of tax. As to the take-up rate for this initiative, I guess we'll have to wait and see, but I don't think in the past people have been too excited by these sorts of announcements. I don't believe this will actually undermine the Australian superannuation system and cause problems for the age pension down the track, as some have suggested, but we'll need to see how it's actually used, or if it's actually used. An increase to Medicare, I don't really need to spend a lot of time perhaps on this point. The 0.5% increase will be felt across the board. There will be at the same time though the cessation of the budget deficit levy of 2%, so an offset for some people who have an income of over $180,000. I don't expect anyone to understand the graph or the chart on the right, but I'm just trying to show in that conceptually how taxation works for people over age 65. So I'll get to that perhaps in a moment, but don't be too bedazzled by that chart. In essence, the announcement last night allows people over 65 to take up to $300,000 each from the sale proceeds from their home, and to pop that money into superannuation outside of the current contribution caps or the new regime. I'm not quite sure how important that will be for a lot of people, or how strategically important will be in terms of the taxation concession. At the end of the day, when people are over 65 and have access to a couple of different forms of rebates, this is the level of income, or a little bit over $30,000 for a single person over age 65, that they can have in income, personal income, before paying tax. So I think the number there is 32,278. For each member of a couple, I think it's about nearly $29,000. So it's quite possible to have quite a lot of money invested outside of superannuation, either in one name or joint names, and to have that investment income fall inside that tax-free area, which compares basically, or puts it on par with superannuation. So we'll see how valuable that concession actually is to people. Maybe the one big concession there is that the work test doesn't have to be met. And prior, what we've had to do is to try and meet a work test for people over age 65, so they were able to put the money into superannuation. But non-superannuation isn't that bad at the end of the day, if that's the default. Affordable housing, look, at the end of the day, whether the CGT concession is really that valuable at the end of the day is a matter of the merit of each individual investment. So the income and the growth, does that really stack up when considering that as a proposition versus any other investment opportunity? I can say in the cases where I've looked at the National Rental Affordability Scheme housing in the past, that the stocks are very low. I think there were 38,000 homes that were released into that system in 2008 when it was announced. And prices have ramped up basically to normalise the actual income or cash flows where they were yielding 9-10%. The yield has actually come back to the pack, and some of those properties are now not as attractive, or not nearly as attractive as they were initially, if you can find stock that has the NRAS certificate. So very much a case by case as to whether that makes housing more attractive as an investment opportunity. So super reforms, you'd be aware probably of the really big ticket items, so the capping on how much one can have in super pensions in their lifetime, $1.6 million. And the other announcements really were, the big announcements were with regard to how much you can put into super and when, what type are they, and a change with respect to the transition to retirement income streams, or transition to retirement income pensions, which a lot of people use as they're moving towards retirement. So the key reforms, these were the announcements last year that actually made it through, if you like, and as you can see, there were quite a few. But what I'm going to really concentrate on this afternoon is the caps, and how do we actually manage the caps? Are they a problem for most people? No, but there's some fairly simple things that we can take on board from today. And also, how do the caps on contributions work? And finally, how does the transition to retirement income stream change in tax assessment affect people as well? So the transfer balance caps, effectively what we are now having to conform to from the 1st of July is to bring everyone back to a maximum of $1.6 million each in pension phase within superannuation. So if you have $3 million in superannuation, that's okay, but only 1.6 of that can actually be in pension phase or as an income stream. At the moment, until 30 June, there is actually no cap. You could have $5 million in an allocated or account-based pension, and you would enjoy the zero tax environment from that, but that won't be the case from July. Because of that, we haven't really had a motivation strategically to equalise or try and have members of a couple with fairly similar superannuation levels. The motivation actually has been the opposite in the past, in that if we have tried to maximise, say, age pension benefits, often there's a benefit in putting superannuation in the younger person's name because they are asset tested later. So superannuation in their name generally is exempt until they reach age pension age. And one of the basic planning tenets, I suppose, is to put superannuation in the older person's name because they reach preservation age sooner, and it reduces the legislative risk, I guess, around having money in superannuation and that leap of faith or committing to superannuation as a saving vehicle. But now we will be more inclined to think about normalising the level of superannuation or making it as similar as we can moving forward. So how bad are the caps? Well, we have three key options at the end of the day. We stay with super and we simply do as much as we can within the caps, so maybe have up to $1.6 million in an account-based pension, and then move everything else, or the excess, back to the accumulation phase within superannuation. So the 1.6 enjoys a zero tax environment, and the $400,000 in this example would be subject to a maximum tax rate of 15% on earnings and on capital gains that are realised. 15% really isn't too bad if it's that fallback position. Unfortunately, it's just not as attractive as the current rules. So there is now a tax cost or an extra impost for people from 1 July where they have super in excess of $1.6 million. The alternative is to remove any excess from superannuation that's over that $1.6 million and to invest that excess in our own name, in non-superannuation investments. And as I've mentioned before, that in itself may not be such a bad scenario either. The other alternative, of course, is that we try and equalise levels of superannuation. So with that excess of $400,000, it's simply withdrawn and then handed to a partner who then makes that contribution themselves and moves that into pension phase also. Ultimately, there's still $2 million invested in pension phase, but there'll now be a split in terms of the ownership. That strategy wouldn't work. Certainly won't work next year if it's a $400,000 lump sum contribution because it's over the new cap. Would work this year. We have a $540,000 cap at the moment, so if we had, say, $2.2 million in super, in an example here, and it was $600,000 as an excess, we wouldn't be able to move all of that across into our partner's account. So there are some limitations depending on the extent of the excess. A few handy tips. This is not advice, I need to say that. Non-superannuation is not to be feared. If that's our fallback, that's not so bad. It's just frustrating that we've spent a lot of years now accumulating wealth, ideally within superannuation for simplicity, to keep everything consolidated and in one pot, to now potentially be reversing that back out again. It's a bit ironic, really. The other strategy to bear in mind is to try and keep as much money in that $1.6 million pot as we can to draw only the minimum pension. And the minimum pension, some of you might know, is a percentage based on age. So if we're just drawing the minimum pension each year, we're giving ourselves a maximum opportunity to grow that pot, and maybe we draw from the excess, which is less concessionally taxed. There is capital gains tax relief. So in the reconstruction of people's superannuation affairs, we do have the opportunity to be relieved of capital gains tax when we move back from all in pension to pension and something else. So we're effectively not being taxed on growth in our investments that have occurred previously all the way through to 30 June this year. That's generally exempt from taxation. The other planning tip might be that if we are now going to be forced into a scenario where we have a number of pots, so we'll have a pension pot, maybe a non-superannuation pot or a super accumulation pot, is we may have the ability to put different sorts of investments in those pots. So if we're wanting to keep our pension account as large as possible by taking minimum drawdowns, we might put all of our growth assets within the pension account, for example. If we, in our balanced portfolio, had a reasonable allocation to fixed interest investments or cash, they might live in accumulation or even in non-super. And if they don't grow as much, then that's okay because they're in a high taxed environment, potentially. So there are some things we can do to try and optimise the ramifications of the change. Getting money into super is, well, it's been getting harder for quite a few years now, in actual fact, but even more difficult from 1 July. We are now saddled with a maximum of $25,000 concessional contribution, irrespective of our age. If you take the 15% tax rate or contributions rate that applies, that's only $21,250. If we compound that for 20 years at 5%, it's $700,000. $700,000 lasts for 25 years if we're drawing $50,000 out per annum. 20 years is quite a long period of time to be saving, and I know from advising people over the last 20 years that generally people aren't saving that much from a young age. It tends to ramp up dramatically closer to retirement. So we now need to change our thinking around saving to superannuation and then think about the conflict of saving to super versus paying our mortgage and how it impacts on our expenditure, like paying for children's education. So it's not maybe as straightforward as it used to be, in that we could put a lot of money into superannuation later and take care of other priorities earlier in life. Not necessarily the same going forward. Concessional contributions, as I've said, we have been suffering a reduction in the level of concessional contributions for some years now. Back in 2006, we were able to put $105,113 into super and get a tax deduction or concession for that. It has slowly but surely been dwindling down to today's $25,000. $30,000 and $35,000 this financial year, subject to your age, under or over 50. But it is only 25 a year now, unfortunately, from 1 July. A couple of good things to come out of last budget's announcements that have been legislated is that we now don't have to salary sacrifice as employees throughout the year to try and get to that $25,000 cap. We are allowed under the new rules to not salary sacrifice at all throughout the whole year, and then to make that $25,000 personal contribution before 30 June, which is a lot easier to calculate than it is at the moment, where we're looking literally at people's pay slips now, working out what's gone into superannuation and what we need to adjust with the remaining pays to try and get right on that $30,000 and $35,000 cap at the moment. So it'll be a lot easier to actually implement the maximum concessional contribution from 1 July. We also have this carry forward option as well. So if for whatever reason we're not utilising the concessional contributions fully in each year, we can actually carry forward the amount that we're not using and make a larger contribution later. There are some riders on that. The carry forward is only available for 5 years, and we can't do that if our balance is in excess of $500,000. Non-concessional contributions. So this is the sort of the voluntary bit that we, the payment that we choose to make into superannuation each year, just to try and grow the pot. There's no tax benefit involved in putting the money in, but the theory is that more money put into the superannuation environment being taxed at very low rates is a good thing for our longer term wealth accumulation. At the moment, we're able to put $180,000 in. We can put $540 in as a 3-year bring forward if we're under 65. That is going to change to $100,000 from 1 July. The 3-year bring forward will still be available. It'll work on the same basis, so won't be available for over 65s. And won't be available at all if we are already at 1.6 million. So that's considered the extent of the savings in superannuation from next year. If we're in this hazy bit from 1.4 to 1.6, there are rules as to how much we can contribute in those scenarios as well, subject to where we come in those bands. So getting money into super is more difficult now. It requires planning earlier. As I've said before though, it doesn't necessarily need to be the default to think that we must save to superannuation. If we are saving nonetheless, and we're investing in our own name, joint names, single names, there will be a considerable margin from age 65 where we're able to earn income from a non-super portfolio and not pay any tax at all. Important thing, if I maybe just jump back, is that up to that level of tax-free income, everything's great, no tax. But as we tick over into that threshold, that red shaded area, then a combination of a few things happens. We not only start paying tax, but we lose on a sliding scale, we lose access to rebates. So in actual fact, for each extra dollar over that point, we're taxed at quite a high rate. So in that red shaded period there in this example, the tax rate on that is actually 48% through a combination of marginal tax rates and loss of rebates. So it's quite important in our planning that we don't just assume that we're happily in the low marginal rates. We will at some point be better off using superannuation, and it does require the calculation. And of course, a one-off capital gains item could flip you quite a long way beyond the zero tax margin or phase. So it does require some planning. But at the end of the day, if we're unable to use super, then it's not the end of the world for a lot of people. So I'm not sure whether that $300,000 concession that people over 65 will have access to in terms of selling their home or downsizing, I'm not sure really how important that may be ultimately. Finally, is it the end of transition to retirement income pensions or streams? Probably for the people that were using the strategy for the purpose that it wasn't intended, but we're all guilty of that. It was an opportunity for people to access the zero tax rate environment for their wealth, for their savings, earlier than retirement. So as soon as people got to age preservation age, or the point at which they could access super, generally speaking, well, for a lot of people, we started the transition pension. That enabled them to accumulate wealth in a zero tax environment. What's happening now is the government have said, well, we're actually going to tax all income and growth within a transition pension at 15%, just like accumulation, so there's no advantage in using it. The only benefit now for people as we see it is that the income from this transition pension is valuable to allow people, or to give them the margin to actually choose then to salary sacrifice some of their wage. So if people are getting transition to retirement income pension of say $10,000 a year, by starting the pension early, they can afford to salary sacrifice some of their wage. And they're sacrificing their wage and saving the marginal tax rate of say 30 or 40% in exchange for a 15% tax rate for the contribution. So it makes good sense in that scenario still. But certainly I would imagine that more than half the people that were using the strategy in the past would now no longer have any benefit at all. All right. So that brings us to questions. I think I've done okay time-wise, maybe a bit too long.
Good timing, thanks Dom. All right, thank you. If you could put your hands together for Dominic and Mark for their presentations.